Hello there. So in this video, I'll demonstrate the solution to in-class problem 3.2, where we will prepare income statements under both variable and absorption costing. We'll do this over a 2-year period so we can see how inventory is affected by changes in fixed costs when inventory both increases and decreases. So here we have Schneider Company, 2 years operating data, and the important thing that's mentioned up front here is that they compute fixed manufacturing overhead by dividing budgeted fixed manufacturing overhead by planned production. And that's basically how we're going to calculate the predetermined overhead rate, or POR. So we have sales data, which gives us how many units were sold each year and at what price. We have variable cost data, which tells us what our manufacturing overhead is, and our non-manufacturing overhead is per unit, and it's different each year. They give us some production data, so actual production versus planned production, and then total fixed costs. So let's calculate the predetermined overhead rate for allocating fixed overhead. And we're going to do this for 2 years, 2019 first. And we know that the calculation is basically fixed cost over planned production. So the fixed costs for 2019 are $2,500,000, and we're going to divide by planned production of 150,000. And that will give you 16.67 repeating as a predetermined overhead rate. If we do the same thing for 2020, we have fixed costs of $2,600,000, and we're going to divide by planned production of 110,000 units. And so that will give you a rate of 23.636 repeating, okay? Our requirements are to compute variable and absorption income for the company for the first 2 years. And to do that, we basically need to go through and construct the income statements for each one. So we'll start with absorption costing first. Okay, so let's get started. So what you have here are all the final numbers, and I'm just going to go through the supporting calculations to save a little bit of time. Sales in 2019 were 120,000 units at a selling price of $45.22. So that gives us $5,426,400. And then we need to calculate cost of goods sold. We start with our opening inventory. In this case, our beginning inventory is 0. And then we add our cost of goods manufactured. Since this is absorption costing, we're going to add both the variable and fixed costs. So our variable cost of goods manufactured was based on 140,000 units produced. And we know that the variable cost is $8.05. So that's $1,127,000. Then the fixed manufacturing overhead is calculated using 140,000 units produced times the predetermined overhead rate of 1667. I'm using rounded numbers here, but these calculations were actually done in Excel, and so these are exact numbers. So 2,333,333. And then we subtract ending inventory. We started at 0, produced 140,000 and sold 120. So that's 20,000 in ending inventory. And we're going to multiply that by the sum of the total inventoriable costs. It's $24.716. And that gives you $494,334. Then we have this other thing here that's called a volume variance. So if I go back up to my data, you see here that planned production of 150,000 units exceeds actual production of 140,000, resulting in a variance of 10,000 units. And I need to account for that because otherwise I won't be capturing all of the fixed costs. The volume variance, 2019, is 10,000 units. And I'm going to multiply that by the 1667 fixed costs only, because the volume variance only relates to fixed costs. So that gives me 166,667, and therefore cost of goods sold is 3,132,667, and that gives gross margin of 2,293,733. And then of course a section for our non-manufacturing costs or operating expenses. Our variable costs are based on the number of units sold, so 120,000 times $3.11 is $373,200. And the fixed costs are $1,005,000, giving us operating income of $420,533. So now we'll look at 2020. We'll do this in green. In 2020, we had 110,000 units sold at a selling price of $43.44. That gives us $4,778,000. And then our cost of good calculation starts with beginning inventory. Now we know that the beginning inventory of one period comes from the ending inventory of the previous period. So we start with $494,334. And then our cost of goods manufactured would be calculated on both the variable and the fixed manufacturing costs. So the variable cost is based on production of 100,000 units, and the variable cost for production in the second year is $8.45. So that gives us $845,000. And then the fixed cost of goods manufactured is $100,000 times the $23,636 in fixed costs. So that gives us $2,363,636 for total cost of goods manufactured of $3,208,636. We then subtract the ending inventory. So the company started with 20,000 units in beginning inventory, produced 100,000, so that's 120,000, but sold 110, leaving 10,000 units in ending inventory. And we're going to multiply that by the sum of the fixed and variable cost. So that's a total of 32.0836. So that gives us ending inventory of 320,864. And then we have that variance again, the difference between actual and planned. So 10,000, it's the same, right? Because we have 110,000 planned and 100,000 actual. And we're multiplying that by the fixed portion of 23 times 636. So that gives us cost of goods sold, $3,618,470. Gross margin or gross profit of $1,059,930. So non-manufacturing variable costs are based on sales of $110,000 times the non-manufacturing variable cost of $331. So that's $364,100. Fixed costs are given at $1,004,000. So your total operating costs $1,764,100. And then you have an operating loss this time, $604,170. So we saw in this case where in 2019, the inventory went up because production exceeded sales. And then in the second year, the inventory dropped because sales exceeded production. Next, we'll look at doing the same thing using variable costing. But before we go ahead and do it using variable costing, there is one thing I want to point out because it could be confusing to students is the treatment of this volume variance. We actually didn't have to do it this way. So this, if we look at 2019, this 166.67, we could have actually just included that volume variance as part of the total fixed costs, and that would just be the 2,500,000, and ignore the 2,333,000. And then basically ignore the volume variance altogether. We would still end up with cost of goods sold, of course, of $3,132,667. And this line item up here is actually not cost of goods available. That's my error there. In the second year, we could have done the same thing. $236,364 could actually have been included here for $2,600,000 instead of separating them both. So you have an option. The volume variance, what it does is actually makes it very clear to the student that we have allocated $2,333,000 and there's $166,667 that isn't allocated, but nevertheless you will still arrive at the same value at the end.